operating profit. So here it is the profit earned through the normal operations and activities of the business. Operating profit is the excess of operating revenue over operating expenses. While calculating operating profit, the incomes and expenses of a purely financial nature are not taken into account. Thus, operating profit is profit before interest and tax. It is also called as EBIT, which stands for similarly abnormal items such as loss by fire, etc. are also not taken into account. So here how operating profit is calculated? It is calculated by applying a formula, where the formula is operating profit is equal to net profit plus non-operating expenses minus non-operating incomes. Now let us take the example here. So when coming to the previous sessions, we had a particular illustration of Ankit, in which we had the deficit, an item relating at 10% interest on long-term loan raised on April 1, 2004. By considering this particular interest on long-term loan, which is of your 5,000 is the long-term interest, on that 10% we considered there, which is of 500. So by considering this particular example, we will see that how to find out the operating profit. So where the operating income or the operating profit will be, operating profit is equal to net profit plus non-operating expenses minus non-operating income. So where operating profit is equal to, where we have net profit is 19,000 plus non-operating expenses, where the interest we have 500 and non-operating incomes we don't have anything, then the answer will be 19,500. Now let us take another illustration by which we will prepare trading account, profit and loss account, and we will see that what is operating income, where the illustration is following balance is extracted from the books of a trader, ascertain gross profit, operating profit and net profit for the year ended 31st March 2005. So before going for the entries, let us take the table first, where the initial entries will be recording in the trading account, then will be recording in the profit and loss account. Particulars amount and particulars amount. So debit side we are going to record all the expenses, credit side we are going to record all the incomes. Sales, in inner column we are going to write 75,250 less sales return, which is 1,250, and in the outer column we are going to record 74,000, which is net sales. So we have opening stock here, which is of 7,600, that will be recorded in the debit side, opening stock 7,600. Then we have purchases less returns. Purchases we have 32,250 and returns we have 250, so the net purchases will be 32,000. Then we have rent, so rent will be considered in the profit and loss account. Then we have stationery and printing, again to the profit and loss account. Then salaries we have, again it will be considered in the profit and loss account. Then we have miscellaneous expenses, traveling expenses, advertisement, commission paid, office expenses. These all are the indirect expenses which will be recorded in the profit and loss account. Then we have wages. So coming to wages is an direct expenses which will be recorded in the trading account. So debit side wages 2,600. Then we have profit on sale of investment, depreciation, which are non-operating expenses which will be recorded later after calculating the operating income or operating expense. Then we have dividend, again sale on loss on sale of old furniture. Then we have closing stock. So coming to trading account, in credit side we are going to take the closing stock. So the entry will be closing stock and the amount given is 8,000. After recording all the entries in the trading account, we have to close the account to find out the gross profit or gross loss. So coming to the total of credit side, we have the total of credit side which is 82,000. So we have net sales which is 74,000 and closing stock we have 8,000. So the total of credit side is 82,000, which is excess than the debit side total. So same total we are going to write in the debit side, 82,000 minus all the above entries. The difference we are getting is 39,800, which will be gross profit. So in the debit side, above the total, gross profit carried down 39,800, and in the credit side, after the total, gross profit brought down 39,800. So we have following expenses here, which are, we have rent, which is 300, which will be in the debit side again, rent 300. Then we have stationery and printing, which is 250, again in the debit side, stationery and printing 250. Then we have salary, again it is an indirect expenses, salary 3000. Then we have miscellaneous expenses, which is 200, again in the debit side, miscellaneous expenses 200. Then we have traveling expenses, again it is an indirect expenses, again it will be recorded in the debit side, traveling expenses 500. Then we have advertising expenses, again in the debit side, advertisement expenses 1800. Then we have commission paid, again indirect expenses, commission paid in the debit side 150. Then we have office expenses, again it will be recorded in the debit side, office expenses 1600. Then we have depreciation, which is charged on the fixed asset which were used in the organization, then again depreciation 800. Before charging the non-operating expenses, we are going to ascertain whether we have operating profit or operating loss. For that, again we have to close the account here, where our income is more when compared to the expenditures. So credit side total we have 39,800, same total we are going to bring to the debit side in the same line, 39,800 minus all the expenditures which we have recorded here, and the balance will be 31,200. That will be considered as operating profit carried down 31,200. Then again in the credit side, after the total, operating profit brought down 31,200. Then we are going to record all non-operating expenses here. So where we have loss on sale of old furniture, which is an loss, which will be recorded in the debit side, loss on sale of furniture 300. Then we have profit on sale of investment, which is 500. So income will be recorded in the credit side, profit on sale of investment 500. Then we have dividend on investment, which is 2,500. Dividend is nothing but income, so which is non-operating income, which will be recorded in the credit side. Investment on, dividend on investment 2,500. Then we are going to close the account here to find out whether we have net profit or net loss. So again we have excess total in the credit side, which is our income is more, which is 34,200. Same total we are going to write in the debit side in the same line, 34,200 minus 300, the balance will be 33,900, which is net profit. So in the debit side, above the total, net profit, and in the bracket transfer to capital account, and the balance will be 33,900. Next concept we have is balance sheet. So when coming to the trading account and profit and loss account, after preparing this account, final account we are going to prepare is balance sheet. So here the balance sheet is a statement prepared for showing the financial position of the business and summarizing its assets and liabilities at a given date. The asset reflects debit balance and liabilities including capital reflects credit balance. It is prepared at the end of the accounting period after the trading and profit and loss account. And it is called balance sheet because it is a statement of balances of ledger accounts and that have not been transferred to trading and profit and loss account and are to be carried forward to the next year with the help of an opening entries made in the journal at the time of beginning of next year. Then when coming to the preparing of balance sheet, all the account of assets, liabilities and capitals are shown in the balance sheet. Account of capital and liabilities are shown on the left hand side, known as liabilities, and assets and other debit balances are shown on the right hand side, or known as assets. There are no prescribed form of balance sheet for a proprietary and partnership firm. However, Schedule 4, Part 1 of the Companies Act 1956 prescribes the format and the order in which the asset and liabilities of a company should be shown. So here the normal format in which we are going to prepare a balance sheet we have here. So where we have one side liabilities and another side we have assets. So coming to liabilities, we are going to take capital. If we have any profit, we are going to add the profit to the capital and it will be shown here. Then we are going to show long-term loans, short-term loans, sundry creditors, bills payable, bank overdraft in the liabilities. So here liability is what which we are supposed to pay today or tomorrow. So liability is our debt we have to clear today or tomorrow, so that will be recorded in the liabilities side. And another side we have assets, where we are going to show all the assets which we have in the organization. So here we will be having furniture or any asset, it might be furniture, plant and machinery, building, motor car, motor van, whatever it is, it will be in the assets. Then we will be having cash balance or bank balance, then goodwill, then again sundry debtors, closing stock, then land and building. So these are the entries which we are going to record in the balance sheet in liabilities side as well as in the assets side. End of the account, both the side total should be same. Relevant items in the balance sheet. So when coming to the items in the balance sheet, first we have current assets. Current assets are those which are either in the form of cash or can be converted into cash within a year. So when coming to the current asset, it is nothing but an item which can be converted into the cash or which has already been converted into the cash. For such item or for such asset, we are going to call it as current asset. Example of such assets are cash in hand or cash at bank, bills receivable, stock of raw material, semi-finished goods and finished goods, sundry debtors, short-term investment, prepaid expenses and etc. So these are the following items which will be coming in the category of current assets. Then we have current liabilities. So coming to current liabilities are those liabilities which are expected to be paid within a year and which are usually to be paid out of current assets. The example of such liabilities are bank overdraft, bills payable, sundry creditors, short-term loans, outstanding expenses, etc. So here current liabilities are those which are supposed to be paid within a period of 1 year and which will be paid out of current assets. Then we have fixed assets. Fixed assets are those assets which are held on a long-term basis in the business. Such assets are not acquired for the purpose of resale. Example, land, building, plant and machinery, furniture and fixtures, etc. Sometimes the term fixed block or block capital is also used for them. Then we have intangible assets. So coming to intangible assets are such assets which cannot be seen or touched. For example, goodwill, patents, trademark are some example of intangible assets. Then we have investments. So coming to investments, investment represent the fund invested in government securities, share of a company, etc. They are shown at a cost price. And if on the date of preparation the balance sheet, the market price of investment is lower than the cost price, a footnote to that effect may be appended to the balance sheet. Then we have long-term liabilities. All liabilities other than current liabilities are known as long-term liabilities. Such liabilities are usually payable after 1 year of the date of the balance sheet. The important item of long-term liabilities are long-term loans from bank and other financial institutions. Then we have capital. It is the excess of asset over liabilities due to outsider. It represents the amount originally contributed by the proprietor or partner as increased by profit and interest on capital and decreased by losses, drawings and interest on drawings. Then we have drawings. Amount withdrawn by the proprietor is termed as drawings and has the effect of reducing the balance on his capital account. Therefore, the drawings account is closed by transferring its balance to his capital account. However, it is shown by way of deduction from capital in the balance. Then we have marshalling and grouping of assets and liabilities. A major concern of accounting is about preparing and presenting the financial statement. The information so provided should be decision useful for the user. Therefore, it becomes necessary that the items appearing in the balance sheet should be properly grouped and presented. Properly grouped and presented in a particular order. Marshalling of assets and liabilities in a balance sheet. The asset and liabilities are arranged either in the order of liquidity or permanence. Arrangement of assets and liabilities in the particular order is known as marshalling. In case of permanence, the most permanent asset or liability is put on the top in the balance sheet, and thereafter the assets are arranged in their reducing level of permanence. Now let us take the illustration from which we have to prepare a trading and profit and loss account and balance sheet for the year ended March 31st, 2006. So here we have purchases less returns, which is 1,60,000, that we are going to record initially in the debit side. So the entry will be recorded in the debit side or in the expenses column. So it will be purchases less returns. In the amount column we are going to record 1,60,000. Then we have commission on purchases 2,000, even it is a direct expense which will be recorded in the expenses. So it will be commission on purchases 2,000. Then we have carriage on goods purchased, which is 8,000, which is an expenses. Again we are going to record in the expenses or in the debit side. Carriage on goods purchased 8,000. Then we have manufacturing expenses, which incurs in the place of production. So that will be again a direct expenses which will be recorded in the expenses. Manufacturing expenses 42,000. Then we have sales less return. So sales is nothing but source of income which we are going to record in the credit side or in the revenues. So when coming to the revenues, we are going to record sales less returns in the amount column 5,20,000. Then we have factory lighting, again direct expenses, again in the expenses amount column, factory lighting 4,400. Then we have dock and clearing charges, which is 5,200. Again it is a tax which is paid on the raw material which is brought to the organization. So here it will be recorded again in the debit side or in the expenses column, dock and clearing charges 5,200. So these are the following informations which relates to the trading account which we have recorded in trading account. So coming to trading account here, total of the revenue we have 5,20,000 and expenses were less than 5,20,000. So same total we are going to record in the both the side 5,20,000, in the same line in the expenses 5,20,000. 5,20,000 minus or whatever expenses we have, if we deduct that, the difference we will be having is 2,98,400, which will be recorded in the expenses side above the total amount column. So 2,98,400 and the entry will be gross profit carried down. Now let us continue with the profit and loss account and we'll see that what are the entries we are going to record in the expenses side. So here carriage on sales 3,500. Then we have advertisement, again it is an indirect expense, advertisement 7,000. Then we have excise duty 6,000. Then we have postage and telegram, again it will incurs in the office or administration, which is indirect expenses. So postage and telegram in expenses side 800. Then we have fire insurance premium, again it is an indirect expenses, again in the expenses side fire insurance premium 3,600. Then we have office expenses, again in the expenses side office expenses 7,200. Then we have audit fees, again in the expenses side audit fees 2,700. Then we have repairs to plant, again it will be recorded in the expenses side repairs to plant, which is 2200. Then we have trading expenses. Again it is an expenses which is on trade, so that will be recorded in the expenses side. Trading expenses 3200. Then we have sales tax paid, so again it is an indirect tax which will be recorded in the expenses side of profit and loss account. Sales tax paid 12,000. Then we have discount allowed, again in the expenses side, discount allowed 2,700. So now all the entries we have recorded in the expense side, and let us see what are the entries we are going to record in the revenue side. So coming to the revenue side, we have interest on investment. So what investment we have made, on that we are going to receive the interest, which is income for us, which is a revenue. So in the revenue side, interest on investment 4,500. Then we have discount on purchases, again it is an revenue which will be recorded in the credit side or in the revenue side. Discount on purchases 3,400. So when coming to the total of revenue side, we have 3,06,300, which is more than expenses. Same amount we are going to record in the expenses side, 3,06,300. Then we are going to deduct all the expenses which we have. If we deduct this, the difference amount we are getting is 2,55,400. So that will be recorded as net profit transferred to partners capital account. So here whatever net profit we have, it will be added to the capital in the balance sheet. After completion of trading and profit and loss account, let us prepare now balance sheet. So now coming to the title here, balance sheet as at March 31st, 2006, and the format will be liabilities amount and assets amount. So in liabilities we are going to record all the entries which relates to the liability, and in assets we are going to record all the assets. So now first let us take the liabilities and will then come to the asset. So now when coming to the liabilities, we have bank overdraft which is of 30,000. So which is a liability of the business to have, which they have to clear today or tomorrow. So coming to the liabilities side, we are going to record bank overdraft in the amount column 30,000. Then we have creditors which is of 61,000. Then again in the liabilities side, creditors 61,000. Then we are going to record the capital. When coming to the capital, we are going to add net profit to the capital, and we are going to deduct drawings and tax paid. So here we are going to take capital, and which is capital we have is 1 lakh, which will be recorded in the inner column. So we are going to record capital in the inner column 1 lakh, and then to that we are going to add net profit, which we have 2,55,400. So 1 lakh plus 2,55,400, then the total will be 3,55,400. From that we are going to deduct the drawings which is of 8,000. So again in the same side, less drawings, again in the inner column 8,000. Then the balance will be 3,47,400. In that balance we are going to deduct the income tax, then again in the inner column itself less income tax, which is of 24,000. And the balance of capital will be having is will be recorded in the outer column, which is 3,23,400. So now we have done with the liabilities side. Now let us see what are the entries we are going to record in the assets side. Coming to assets side, we are going to record first whether we have cash in hand or cash at bank. So what cash balance we have? So we have cash in hand which is of 2,500. So coming to asset side, first entry, cash in hand 2,500. Then we have debtors which is of 80,000. Then we have closing stock which is 76,000. Then we have investment which is 30,000. Then we have motor car which is of 60,000. Then again in the same side, motor car 60,000. Then we have plant which is costing 1,53,900. Again in the asset side, plant 1,53,900. Then we have patent which is 12,000. So we have recorded all the assets and all the liabilities. Now let us see the total of both the side. So when coming to the balance sheet, in liabilities in assets we should get same total. So total of liabilities side we have 4,14,400, and in assets also we have 4,14,400. So here all the liabilities are equal to the assets.